Preparing for a risk analyst at CaixaBank interview? You've reached Candy Mentor, and this video is for you. We'll walk through 20 key questions you're likely to face. For each question you'll see a sample answer followed by the key points to cover. Subscribe, like, and share, and drop a topic request in the comments. Question 1. Why do you want to work as a risk analyst at CaixaBank? I am attracted to CaixaBank because risk management directly influences millions of customers and a broad Spanish banking franchise. The role combines analytical work with practical judgment, assessing borrowers, monitoring portfolios, challenging assumptions, and communicating decisions clearly. I also value CaixaBank's regulated environment, where model quality, governance, and responsible finance matter. My strengths in financial analysis, data interpretation, and structured problem solving would help identify emerging risks while supporting sustainable business growth. While answering, connect your interest in quantitative analysis, banking stability, customer impact, and CaixaBank's scale in Spanish retail and corporate banking. Mention regulatory discipline, collaboration, and how your skills support prudent, commercially useful decisions. Question 2. How would you assess the credit risk of a corporate borrower? I would begin with the borrower's business model, competitive position, management quality, and industry outlook. Then I would analyze revenue stability, margins, operating cash flow, leverage, interest coverage, liquidity, debt maturities, and covenant headroom. I would review collateral and guarantees but avoid relying on them instead of repayment capacity. Finally, I would stress revenue, margins, rates, and refinancing access, compare results with CaixaBank's risk appetite, and document mitigants and monitoring triggers. Make sure to cover business model, industry, management, financial statements, cash flow generation, leverage, liquidity, collateral, covenants, relationship history, and forward-looking stress scenarios before reaching a balanced recommendation. Question 3. Explain probability of default, loss given default, and exposure at default. Probability of default estimates the chance that a borrower defaults over a defined horizon. Loss given default measures the percentage of exposure not recovered after collateral, guarantees, costs, and recoveries. Exposure at default estimates the amount outstanding when default occurs, including potential future drawings. A simple expected loss framework is PD multiplied by LGD and EAD. I would also distinguish expected loss from unexpected loss, which informs capital requirements and risk appetite. In your answer, define PD, LGD, and EAD precisely, explain how they combine into expected loss, and distinguish borrower default likelihood from recovery severity and outstanding exposure at the default date. Question 4. How does International Financial Reporting Standards 9 expected credit loss provisioning work? International Financial Reporting Standards 9 uses a forward-looking expected credit loss model. Stage 1 generally records 12-month expected credit losses, while Stage 2 records lifetime losses after a significant increase in credit risk. Stage 3 applies when credit impaired, with interest recognition based on the net carrying amount. Estimates combine PD, LGD, EAD, macroeconomic scenarios, and discounting. I would challenge assumptions, validate staging, and ensure overlays are evidence-based, transparent, and properly governed. Be sure to mention the 3-stage framework, 12-month versus lifetime expected losses, significant increase in credit risk, probability-weighted scenarios, forward-looking macroeconomic information, and management overlays with strong governance. Question 5. What indicators would suggest a significant increase in credit risk? I would compare current lifetime default risk with the risk at origination, using both quantitative and qualitative evidence. Indicators could include a material rating downgrade, rising leverage, weaker cash flow, overdue payments, covenant breaches, watchlist placement, forbearance, or deterioration in the borrower's sector. I would also consider adverse macroeconomic developments. The assessment should follow documented thresholds, but expert judgment matters when data is incomplete or a rapid deterioration is emerging. Focus on material deterioration in lifetime default risk since origination, rating migration, delinquency, watchlist status, forbearance, covenant breaches, adverse financial trends, and relevant qualitative or sector-specific evidence. Question 6. How would you perform a stress test on CaixaBank's loan portfolio? I would define a coherent adverse scenario, such as recession, unemployment increases, falling property values, and higher interest rates, rather than shocking variables independently. I would segment exposures by product, geography, sector, collateral, and borrower quality, then translate macro assumptions into PD, LGD, EAD, earnings, provisions, and capital impacts. I would test sensitivities, assess concentration effects, compare outcomes with limits, and identify actions such as tighter underwriting or increased provisions. In your answer, explain scenario design, macroeconomic drivers, portfolio segmentation, transmission to PD, LGD, EAD, net interest income, capital, and liquidity, followed by management actions and sensitivity analysis. Question 7. What is the difference between market risk and credit risk? Credit risk is the possibility that a borrower or counterparty fails to meet obligations, creating loss through default or deterioration. Market risk arises from unfavorable movements in rates, foreign exchange, equities, credit spreads, or commodities. For example, a corporate loan primarily carries credit risk, while a bond portfolio carries both spread and default risk. The distinction guides measurement and limits, although risks interact. Higher rates can weaken borrowers and increase portfolio defaults. Make sure to distinguish counterparty repayment failure from losses caused by market price movements, then discuss examples, measurement tools, limits, hedging, and how both risks can interact during stressed conditions. Question 8. How would you evaluate interest rate risk in the banking book? I would assess both earnings and economic value perspectives. First, I would map assets, liabilities, and off-balance sheet items by repricing date, incorporating fixed rates, floating rate resets, deposit behavior, prepayments, and early withdrawals. Then I would model parallel and non-parallel yield curve shocks, basis changes, and optionality. I would analyze net interest income, economic value, capital implications, and limit utilization, challenging behavioral assumptions because deposit stability can materially change CaixaBank's exposure. Discuss repricing gaps, duration or economic value sensitivity, net interest income sensitivity, deposit behavior, behavioral assumptions, yield curve scenarios, basis risk, optionality, limits, and escalation under adverse outcomes. Question 9. What is liquidity risk, and how would you monitor it? Liquidity risk is the inability to meet obligations on time without unacceptable losses or funding costs. I would monitor projected cash inflows and outflows, maturity mismatches, deposit concentration and stability, wholesale funding access, collateral availability, and liquid asset buffers. Regulatory measures such as LCR and NSFR provide important discipline, but I would also review behavioral and stress scenarios. Escalation triggers should connect directly to a contingency funding plan and defined management actions. Cover the risk of meeting obligations when due, cash flow forecasting, liquid asset buffers, funding concentration, deposit stability, maturity gaps, LCR, NSFR, contingency plans, and early warning indicators. Question 10. How would you investigate a sudden increase in non-performing loans? I would first validate the data, definitions, reporting period, and any changes in classification or cure policies. Next, I would decompose the increase by product, region, sector, vintage, rating, collateral, and relationship manager to identify concentration or cohort effects. I would investigate economic drivers, underwriting weaknesses, fraud, and operational issues, then assess coverage, staging, capital, and forecast implications. The response might include intensified collections, portfolio limits, revised underwriting, or targeted customer support. In your answer, separate data or classification issues from genuine deterioration, segment the movement by product and geography, identify root causes, assess provisions and capital, and recommend targeted remediation. Question 11. What is concentration risk, and how would you manage it? Concentration risk occurs when losses are disproportionately driven by a common borrower, sector, geography, product, collateral type, or risk factor. I would identify concentrations through exposure and stressed loss analysis, not only borrower counts, because correlated names can create hidden vulnerability. Management tools include single name and sector limits, diversification, collateral requirements, pricing, syndication, and portfolio sales. At CaixaBank, I would escalate breaches promptly and test whether concentrations remain acceptable under adverse scenarios. Mention excessive exposure to one borrower, group, sector, geography, product, collateral type, or risk factor. Explain limits, diversification, correlated stress testing, early warnings, and risk-adjusted pricing. Question 12. How would you validate a credit risk model? I would start by reviewing the model's purpose, methodology, data lineage, assumptions, and implementation. Performance testing would cover discrimination, calibration, stability, backtesting, overrides, and outcomes across relevant segments and economic periods. I would benchmark results against alternative models or expert judgment and test sensitivity to key assumptions. Findings should be documented with severity, ownership, deadlines, and compensating controls. Independent validation is essential because model developers should not approve their own work. Be sure to cover conceptual soundness, data quality, discriminatory power, calibration, stability, backtesting, benchmarking, stress performance, documentation, independence, and remediation of limitations. Question 13. What is model risk, and how should a bank control it? Model risk is the potential for financial, regulatory, or decision-making harm because a model is wrong, poorly implemented, based on weak data, or used outside its intended purpose. Controls should include a complete model inventory, risk-based tiering, independent validation, approval committees, performance monitoring, version control, documentation, and clear limitations. I would also assess overrides and explainability. When a material weakness appears, temporary controls and conservative adjustments should protect decisions while remediation proceeds. Explain that model risk comes from incorrect outputs or misuse, then discuss governance, inventory, tiering, validation, approval, monitoring, change control, documentation, limitations, and human oversight. Question 14. How would you assess a mortgage portfolio's risk at CaixaBank? I would examine borrower income stability, debt service ratios, loan-to-value, employment, rate type, remaining maturity, geographic concentration, and property market conditions. Portfolio analysis should compare vintages, origination channels, arrears, cures, restructurings, and recoveries. I would stress unemployment, interest rates, and property values, recognizing that payment capacity usually deteriorates before collateral recovery becomes relevant. The conclusion should combine expected loss, capital impact, affordability concerns, and practical monitoring or underwriting recommendations. Discuss borrower affordability, loan-to-value, debt service burden, employment, property values, geographic exposure, vintage performance, interest rate sensitivity, arrears, collateral realization, and responsible lending considerations. Question 15. How would you incorporate climate and ESG risks into credit analysis? I would treat climate risk as a driver of traditional risks rather than a completely separate category. Physical events can damage collateral and disrupt operations, while transition policies, technology, or carbon prices can weaken certain borrowers. I would assess sector exposure, location, emissions intensity, transition plans, insurance, and financing needs, then use scenarios and qualitative judgment where data is limited. The results should influence rating, covenants, pricing, portfolio limits, and engagement without accepting unsupported ESG claims. Focus on physical and transition risks, sector materiality, borrower emissions and plans, collateral exposure, scenario analysis, data limitations, greenwashing concerns, and integration into underwriting and monitoring. Question 16. Tell me about a time you found an error in financial or risk data. During a portfolio analysis, I noticed that one segment's delinquency rate dropped sharply despite worsening borrower metrics. I traced the calculation to a filter that excluded recently transferred accounts. I reproduced the issue, quantified the reporting and provision impact, and raised it with the data owner and reviewer using evidence rather than blame. After correction, I added a reconciliation check and documented the definition. The experience reinforced that data controls are as important as analytical sophistication. Use a clear situation task-action-result structure. Explain how you detected the anomaly, validated the source, assessed materiality, communicated professionally, corrected the process, and prevented recurrence. Question 17. How do you prioritize competing risk analysis requests? I prioritize requests by potential financial or customer impact, regulatory importance, urgency, and decision dependency. A regulatory submission or emerging portfolio breach would normally precede a lower impact exploratory analysis. I clarify the decision required, estimate effort, identify reusable data, and agree realistic milestones with stakeholders. If priorities conflict, I escalate the trade-off early rather than silently reducing quality. I also provide an initial directional view when useful, clearly labeling assumptions and limitations. Mention customer and financial impact, regulatory deadlines, severity, immediacy, dependencies, effort, stakeholder alignment, transparent trade-offs, and escalation when capacity or data quality threatens delivery. Question 18. How would you communicate a risk finding to senior management? I would lead with the headline: what changed, why it matters, and whether risk appetite or limits are affected. I would quantify exposure, expected loss, capital or liquidity impact, confidence level, and key sensitivities. Then I would explain the main drivers in plain language and present practical options, including costs and trade-offs. A concise dashboard can support the discussion, but I would be ready to explain methodology, data limitations, and recommended ownership. Be sure to lead with the conclusion, quantify exposure and uncertainty, explain drivers, compare with limits or appetite, present options, state assumptions, and recommend specific actions without excessive technical detail. Question 19. What would you do if a business team challenged your risk recommendation? I would first understand the business team's evidence and commercial rationale, because challenge can reveal missing context or data. I would retest the analysis, distinguish facts from assumptions, and explain clearly which risk indicators drive my recommendation. Where possible, I would offer mitigants such as lower exposure, stronger covenants, collateral, monitoring, or staged approval. If disagreement remained material, I would document both views and escalate through the appropriate governance process, preserving independent judgment. Discuss listening to commercial context, testing facts, separating assumptions from conclusions, maintaining independence, proposing mitigants, documenting disagreement, and escalating through governance when material risk remains unresolved. Question 20. What makes an effective risk analyst in a regulated bank such as CaixaBank? An effective risk analyst combines technical accuracy with judgment and communication. They understand financial statements, data, models, regulation, and portfolio behavior, but also ask whether an output makes business sense. They remain independent, challenge assumptions respectfully, document decisions, and escalate concerns promptly. In CaixaBank's environment, I would add customer responsibility, awareness of regulatory expectations, and strong control discipline. The best analyst does not simply reject risk. They help the bank understand, price, monitor, and manage it. Highlight analytical rigor, sound judgment, curiosity, data discipline, communication, independence, commercial awareness, ethics, regulatory understanding, and willingness to challenge respectfully while supporting well-controlled growth. If you are still with us, congratulations, you are much ahead of the rest and serious about preparing for your interview. We hope we were able to add value to your preparation and create some helpful content. Do not forget to like and share this video. Your small act can do great things for us.